Good morning, everyone. We're just going to get started maybe in just a few minutes, just waiting for a couple more people to get on here. We'll get started. Thanks for attending. Oh, good. Eli's here. Okay, we're going to get started. So thanks you guys for taking a little bit of time out of your day today. We will go about 30 minutes or so. We'll try to keep it brief. We know you have a lot of things to do today, but we want to make sure this time is spent wisely. So what we're going to do is talk a little bit about the stock market and investment accounts, what they've done so far this year. It's been a volatile year for sure, but things have actually looking really good right now. And then we're going to jump into the economy, and then Eli will actually take over a little bit in the second half of the meeting, talking about the stock market, and then share a little bit of some of the optimism we have going forward. Maybe before I get started, just an observation over the last 2 years as we've been meeting with clients. It's interesting. We've had a lot of people that have thought initially in our meetings that the stock market had done horribly bad, and it was down both under President Biden in 2024. Last year, stock market was up over 20%. And this year, with a new president, likewise, a lot of people come in and think that the stock market economy is in a toilet, but stock market's up about 13% so far this year. So maybe just a reminder that news can skew our viewpoints on things. And today we're not going to be relating to news or politics whatsoever. We are just going to be focusing on data. So we're just looking at raw data. We don't follow the generalized news that much, but we do pay a lot of attention to the economic data because that's really what drives your portfolios and performance. So we'll get started here. I'm just going to share my screen. Okay. All right. So starting off this year, stock market was up about 5% from January until about February 19th. And there's a lot of optimism early in the year, new president, a little bit more business-friendly environment. And with that, the stock market rose, like I said, about 5%. But started in February, there was a lot of news around tariffs and a lot of worry around tariffs. And from February 19th through April 8th, the stock market sold off almost 19%. So pretty severe drawdown. It was scary and it was fast. And what we saw is this is not a out of the ordinary thing. Stock market is quite volatile, and you can look here anytime the stock market's down over 20%, that's a bear market. So these are near bear markets, 19% or so drawdown. If you look at that historically, it's happened quite a few times. And if we look at a month, stock market this time was up 13.7% over the last month. The last 3 months, it's up almost 25%. And then if you look, this isn't quite 6 months. This is as of yesterday. Stock market's up 33.36%. That's not year to date. That's off the bottom of being down 18.9%. So it's been a very strong rally. If you look historically, on a 3 month, out of all these cases, average returns 15.8. 6 months is 25.8, so we're trending a little better than the average. And then if you look at it over a full 12-month period, on average, stock market's up about 30%. So we might be a little ahead of schedule in that regard. We do think markets will continue to be volatile with time, but so far it's been a pretty remarkable rebound off those bottoms, and that's why it's super important to stay focused on your long-term goals and not let short-term jitters or news headlines or issues that are happening have that sidetrack you in the near term. It's good to keep focused on the long haul. So as you can see here, volatility is very common. And on average, we have about 3% drawdown about 7 times every year. A 5% is a mild correction about 3 times a year. A market correction, and you might hear that a lot by market pundits, that's down 10%. That happens about every year. And then severe corrections down 15% happens once about every 2 years, and a bear market happens about every 3.5 years. The last bear market we had was actually in 2022 when we had rampant inflation due to a lot of extra stimulus coming into the economy after COVID, and the Federal Reserve keeping rates very, very low. Um, that caused a major spike in inflation, and you guys all saw that in regards to food prices and everything else. And with that, the Federal Reserve ended up jacking up interest rates about 5%, and that's what caused the drawdown in the stock market because the Fed was basically reacting to an inflation that it got clear up to 9.1%. And so they basically threw some water on the fire or the stock market and the economy basically to reduce some of the amount of consumption, et cetera, by raising interest rates. So again, as you guys all know, you've been investing with us for a long time. Markets can react and they can react violently, and that's just part of the deal. And part of the reason for that is the stock market's always anticipating out 6 months from now. So if they get a little data point, market's going to be reacting immediately to that point, and it can cause some volatility. All right, looking at the economy. So this is just looking at key economic indicators, and all of these look really pretty good. If you look, the last 3 months is in blue, 23 to 24 is in purple, and then pre-pandemic, before 2020, is in black. So you can see here, real wholesale and retail sales up 3%. Over the last 3 months, 23, 24 up 1.7%, so very strong. Personal income is up accordingly. Personal consumption is in line. Industrial production is massive over the last 90 days. A lot of that is due to energy infrastructure build out and also data center build out with AI, et cetera. Not for payrolls, so employment numbers are still in line. They're lightening up a little bit, and I'll talk a little bit about that. So as a whole, nothing really scary that's pointing to a recession right now. Our earnings have been really, really strong across the board. So earnings are strong. The economy is still good, and the Fed just dropped interest rates by 25 basis points, which is a little bit of stimulus. Really, we don't think it'll make much of a factor in the economy at this point, but they were just a little overly restrictive due to worries about inflation around tariffs, and we think that's very, very understandable. So looking at the economic growth of the economy, you can see here this blue dash line, that's just looking at trend growth. So from 2001 through current, the economy is growing by about 2.1% over that time frame. The gray chart or the gray line is actual growth of the economy. So you can see here from 2001 through really 2008, it was above trend, and then you see that little spike downward. You may or may not remember what happened there. A pretty horrific time. That was a real estate bubble, and that was a painful scenario for sure. And through that, the Fed ended up dropping rates and a whole bunch of quantitative easing, money getting pushed in the economy to keep it up, and it took a long time to work that off. Interest rates were basically at zero for almost this entire time, and then COVID. Unfortunately, we do remember that. And then currently, we are actually back above trend, so slightly above. So again, another indicator not pointing to recession, at least at this point. Everything looks really good. Over here on this right-hand side, just looking at components that make up our U.S. economy that makes it run. Well, the good thing is, us as Americans, we're really good at at buying things and spending money. So 68% of it is us consuming things and buying things. So that's a big thing. Smaller though is federal government spending is only 6%, and state government spending is only about 11. So again, the biggest component of that is us as consumers. That leads into this next slide, looking at unemployment. And if you look up top here, 50-year average unemployment rate 6.1%, average over the last 50 years, wage growth about 3.8%. So unemployment rate currently is at 4.3, and that's ticked up slightly over the past year from about 3.9. So it is peaking up a little bit. And wage growth, about 3.8% is the 50-year average. We're currently about 3.9%. Good thing is we've worked off a lot of nastiness around COVID when a lot of things were shut down. We worked through all of that, and things are actually have normalized. Reason why I believe that job numbers or unemployment numbers have gone up slightly is this is something I learned yesterday. If you look at the United States, we've actually had about 1 million people immigrating, and this is legally immigrating into the country. About 1 million people per year. That's about the size of Denver every year. So far this year, we've actually had about 250,000, a negative 250,000 to immigration. So actually in the negative, and that's due to the border getting closed up and a lot of actually people leaving. So with that, we do think we're very, very close to full employment for the most part. So I would think some of these job numbers should maybe reflect some of that. Today, this morning, early, there was unemployment data that came out. It actually came in better than expected, meaning there was fewer unemployment than expected. So we're not seeing a whole lot of people firings or layoffs around any of that. That's a worry. The reason I bring that up is artificial intelligence is coming into the picture, and with that could take a toll on jobs. But we do see many companies starting to implement AI into their businesses. But so far, they're not laying off many people. They're just not hiring as many. So they're holding on to their workforce and then implementing some of this technology to become a little bit more efficient. Consumer finances. Again, this is key. We're going to focus on the bad first. So if we look down to the bottom right, this is early flows and delinquencies. This is just a good way for us to take a current snapshot and look at how good the average consumer is. And you can see here in orange, it's glaring. Student loans delinquencies up 13%. That was mainly due to the sunset of the payment. There was a 3-year pause basically for people with student loans that in having to pay that back. It sunsetted in 2023, but then there was a whole other year where they wouldn't report any delinquencies to credit bureaus. Well, in 2024, actually in 2025, that kicked in. So you can see here that is the reason why that is on the rise is because a lot of people with student loans are choosing not to pay that back. Mortgages still in line, 3.7%. Again, reference point, here it was about 13% back in the heat of the real estate bubble. So still really good there. Credit card delinquencies are on the rise a little bit, 8.6%. Car loans are on the rise a little bit, but still looking out since 2003, still not too bad. Credit cards maybe going up a little bit. That's most likely just people getting pinched with the high costs of life. In that the inflation that happened during 2020, 21, and early 2022, we are still feeling the effect of that. Even though inflation's back down to about 3%, the massive amount of inflation that we felt during those timeframes basically is still there. That 3% inflation rate, it just means that the current rate is only going up at 3%, but it's 3% on top of the amount of high inflation that we had in the past. So some of the lower income citizens definitely getting pinched a little more, and that's something to keep an eye on as well. Household debt service, this top right, this is looking at the amount of disposable income that U.S. households have that they're actually spending on liabilities. And you see here, really 11.3%. Back in the 80s is 12.4. In kind of the height of the real estate bubble, about 15.8%. Reason why it's so low, 2019, 2020, 2021, the mortgage rates got down in the 2.5% to 3% range. And most people with a mortgage have the ability to actually refinance. So we're seeing a lot of people that are in homes at very, very low rates. And with that, that gives them more ability to spend. But also what we saw during that high inflationary environment is we saw inflation not only in homes went up a lot in value. That means these people, or all of us that have equity in our homes, if we get into a pinch or a hard time, we got another lever we can pull, maybe refinance or a line of credit, something if we get into a bad situation. That's more flexibility. The other thing we saw with inflation as well, stock market. And again, just a reminder, stocks do very well in an inflationary environment. On this left-hand side, far left here, interesting thing, homes used to be one of the biggest assets that U.S. households or citizens had, still is, but financial assets, investments have become a much larger piece of that. Deposits, that's CDs and money markets, et cetera, only 7%. So a lot of money has been flowing into the equity markets, and we think that's a healthy thing. So this side's the assets, over here liabilities. Biggest liability U.S. citizens have is mortgage on their home, 67%, student loans about 9%, car loans about 7%, revolving debt, credit cards about 6%. So not horrible. Things are still, again, if I'll go back to the employment numbers, if everybody, for the most part, has the ability to get a job and work, they're going to go out and spend money. So that's what's keeping things rolling. Plus, with maybe a lot of extra spending around new technologies as well. Okay, I'm going to pass the time over to Eli to take off on the stock market.
Awesome. All right.
Let me stop share.
All right. Can you see that, Parker?
Yeah.
All right. So talking about the stock market, Parker and I were talking like, what are the kind of biggest questions and concerns people are coming to us with as we're having conversations. Really, I think it boils down to two things. One, we're hearing, hey, the market is at all-time highs. Are we going to get a rug pull? And then the other part of it is valuations are rich for the companies, right? And both of these kind of create some hesitancy and a little bit of worry. So we'll kind of dive into that, kind of look under the hood on those two main topics. If I can get this to
just down arrow.
So the first one is valuations are rich, and they kind of are, right, historically. So if we look here, and it's a little concentrated towards the top. So typically and historically, those top 10 companies in the S&P 500 typically demand a higher multiple than others, simply because those are going to be the companies that are in the forefront of whatever technological advancements and whatever cycles are happening. For the remaining stocks, historically, we're high as well, right? So historically, the remaining stocks at about 15.8 multiple, we're at 20.6. And so really what this is telling us is for every for the price of the shares that you're paying, how much are we getting back in earnings? And for that ratio, it's a little bit high. And so what does that really mean? And I think this really tells a pretty good story. There's a reason why valuations are high and why the stock market keeps hitting new all-time highs. And it's more fundamental than it is technical. So if we look at the fundamentals of it, we look at these earnings growth. And really just over these last few years, your Mag 7 stocks, so your NVIDIA, Microsoft, Google, Meta, and so forth, their earnings growth was 40% in 2024. That's massive, especially given for how large those companies are, and they're seeing that type of growth. That's a very positive indicator. And even though it's come down, these are still very large, outsized earnings growth numbers for the size of companies that are experiencing this growth. Something to really point out is this blue bar. So it's the rest. So the other, 493 stocks in the S&P 500, their earnings are starting to grow. Now, when you look at this kind of on a macro level, it's because what has really given these companies this earnings? Well, it's because they're the ones creating AI, right? They're the ones creating the microchips and the technology that is going to fuel this technological advance. So all the money has been going there because all these companies need that. So they've had this outsized growth and these massive earnings. Now they start to come down, but then now you're seeing these companies' earnings increase because now they're able to utilize this technology in a more effective way and are able to grow their earnings along with it. So even though valuations are high, earnings are high and they're continuing to grow. The next part of it is consumer sentiment. This is actually a pretty good indicator of if we've really hit a peak or not. So if you look here at these blue dots, these show when we've hit peak sentiment, when people are euphoric, this is never going to end, this is fantastic, the market's just going to go up forever. When that happens, when that sentiment is that high, your average return for the remaining year is only about 3.9%, right? But when sentiment has hit its trough at these bottoms, at these lows, your 12-month return has averaged 24%, right? Here we are all the way over here, this green square or diamond, depending on how you're looking at it. But we're here all the way down here at the bottom. So we're not euphoric. People are cautious. There's $7 trillion sitting in treasuries currently. The companies are holding back on certain aspects and certain growth items. We've seen that some of that in the job numbers. It's just people are kind of sitting still, waiting for that next moving catalyst, and we're starting to see that come around. Just as we saw in that last slide, that earnings growth starting to move. So people aren't over the top optimistic; they're actually pretty cautious. The next indicator is where are we at in this cycle, right? We've hit all-time highs. Can this continue to happen? Well, historically, a bull market lasts for 70 months. Your typical bear market, 14 months. So a 70-month run, where are we at in that cycle and in this trend? We're only at 31 months. So we're only halfway to your typical average bull run. And in my opinion, I think this could be one of those more extended bull runs just because this technology is going to permeate all throughout all economies and sectors and areas. So this isn't something that is just going to be kind of a one and done, hey, this is a great new technology or product, sold by Apple or something. This is something that all companies, across the entire globe are going to be able to benefit from. And we're in the early innings of a bull market. The next big indicator that we see is the capital expenditures. So companies, Alphabet, Amazon, Meta, Microsoft, just what they have announced. And even since this slide was created just a couple days ago, right? NVIDIA and ChatGPT, they're creating a partnership for even bigger build outs. And their spends are expected to be in the hundreds of billions of dollars. So these numbers on top of that, we're looking at around $400 to $500 billion in capital expenditures to help build out the infrastructure and the buildings and everything that goes around supporting AI and cryptology and these new technological advancements. So the way I like to look at this, and some of you have probably heard us say this, think of it as the government is essentially putting together a stimulus package every year, of $400 billion that's getting moved back into the country. And you can kind of see that with some of the policies that are being made. trying to get those dollars to stay here and be built out here in the United States to continue to grow the economy. So there's a massive amount of spend that's coming. The other item to see, and I touched upon this a little bit earlier with the growth trend of the other companies outside of the Mag 7, how are we best utilizing AI to produce goods and services? Right here, only about 10% of the companies are actually being able to effectively use AI currently. So they're still learning how to adopt it in the best of ways. So again, that part of it in terms of efficiency and growing their earnings is also in the early innings of it. And then really this just kind of shows the risk of investing and the power of compounding and not worried about these day-to-day items. So where are you going to really find, that value and the opportunity to continue to grow and move those portfolios, right? And that's Parker and I's job. I would say the areas that we're looking at currently, so we've seen a great run up in those companies that have created AI, but now as they've announced these big expenditures, we're now looking at who are those companies going to be that are going to be able to benefit from all of that spend. So you've probably seen in some of the portfolios for those that have like our focused equity portfolio, you see companies in there like Emerson and Caterpillar and so forth that are going to benefit from building all those buildings, pushing dirt around, laying concrete, putting up power grids and so forth. Those are the companies that are now going to benefit from that waterfall effect. So overall, I would say, things to think about when you're thinking of those two things. Are we at all-time highs? Is this going to end? Is the rug going to get pulled? Think, as Parker went through, the economy is strong. We're seeing outsized earnings growth. Technology has been leveraged, hasn't been fully leveraged and trickled down to all the other companies and sectors. We're only halfway through a typical bull market run. Sentiment is at all-time lows or near lows. It's at a basically near bottom, and we're not over leveraged, right? As Parker showed in that other slide, everybody's not leveraged to the gills on and wondering, hey, I got to sell out in order to pay bills, right? And then the last part is, the technologies that are coming out with AI and cryptology. These are in and of itself growth engines and earning engines that are just going to keep feeding and continue to improve over time. So I would say the best way to think of it is we look at things and we're looking at it long term. We have that kind of long-term mentality, and we see a pretty big run, over the next 5-10 years. This could really advance, but at the same time, we understand there's going to be ups and downs, blips in valuations, and what we're looking at is where should we be deploying those dollars to take advantage of this run that we see over the next 10 years.
Yeah, well said, Eli. There's always going to be uncertainty around a lot of things. Again, we're fairly optimistic, but again, steering back to your portfolios, we are. There's a good saying I like: when in doubt, diversify it out. So we're well diversified inside your portfolios. We're not getting over allocated in equities above and beyond what your risk tolerance is. We're definitely keeping that in check. So. But we, as a whole, we are fairly optimistic about the long haul over the next 5-10 years with a lot of this innovation. Again, one of those reminders about investing is if you see these long-term themes, and some of those are around AI, data security is equally as important as AI as a theme, but also energy revolution. These are all 5-10 year plays. And if we're allocating funds today, we think we're still relatively early. We're throwing dollars and putting our money and your money in front of the big wave of money coming behind it. And that's generally pushes up the valuations of the stocks and the companies that we're owning. We're going to switch gears to Q&A. If you have any questions, just type it out in the webinar chat and we will address them as best as we can. We'll take a few minutes and a few different questions. So if you have questions, please fire away. There's one already that came in, and I'll actually start off on that. Is basically client wrote in, I have a daughter who's trying to get into a home. What are rates going to be doing over the next year or two? And that's a great question. It's super hard for young people to get into homes. As I mentioned before, inflation had pushed up prices of homes and home values, as you all know, in Utah, for those of you in Utah, Idaho, California, wherever you're tuning in, valuations were lower. And then around COVID, with people deciding they could potentially work from home, a lot of money was spent on homes and home values went through the roof. Shortly after that, we had the inflation issue because of all that spending, and the Federal Reserve jacked up interest rates. So we went from an environment from where housing affordability in 2019 and 2020 were some of the best to now it's among the worst because house prices have gone up, but also interest rates have as well. So good question. The Federal Reserve last year, 2024, cut interest rates 3 times. So there's a 25 basis point cut, or a 0.75% as a whole. And just last week, Federal Reserve cut another rate, another percent. So interesting thing is, if you look at rates over this mortgage rates over the last 2 years, they've ranged from about 6.3%, which that's where we're at as of today, clear up to 7%. But we've been in this tight range, even though the Federal Reserve has dropped rates. So the Federal Reserve, they only control the short end. That's just the date, basically the overnight rate that banks lend. That's the only thing they control. The rest of the bond market, or the yield curve, sets itself. So we haven't seen rates come down really at all over the last year and a half. They have come down a little bit. Again, 6.3%. My opinion, we work with a few different builders, and they expect if rates get into the mid fives, it's going to be madness because there's a lot of people living in apartments waiting to get in. My opinion, if we're at 6.3% now, it'd probably be good to actually look at getting into a home, because I think if rates do get down in the fives, housing prices will go back up. Housing market's in the toilet, meaning it's not going up as quickly as it has, and it's actually housing prices have come down a bit. You can once you get into a home, you can always refinance if rates do go lower. But I honestly, there's still a net amount of people waiting to get into the Utah and the mountain states. So if your daughter, son has funds available to get into a home, probably not a bad idea to get into one and worry about rates potentially going down later. Let's see. All right. What sectors do you think will be the next big beneficiaries for these technological advancements? Want to take that one, Eli?
Yeah, sure. So I think it depends on the technology. So you've got AI, I think, is going to be one of those that everyone is going to be able to benefit from. I think probably the vast majority of you that I've spoken to, you're seeing it at your own companies, you're seeing it in your personal life. So I think that's something that's going to just really permeate through the entire economy, right? Very similar to the internet. Cryptology, I think that's, it's something that sounds complex, but I think it's pretty straightforward. In the end, what it is just allows for more seamless transactions, kind of sticking with that housing theme. If you're able to move ownership on chain in a very protective way, in a way that can't be changed up, and you're able to make those transactions on that chain, essentially you're eliminating the need for some of those middle people in terms of title and escrow and so forth, and you're saving thousands in costs and time And it's really, so when you think of it that way, and this can be applied to many other sectors. In fact, they've been talking about the SEC, and even Robinhood has done this already, where they're starting to put actual stocks on chain. All that simply means is that it's just putting it on a grid system that just makes things much more efficient. And then the other one is, now this, I think it's a little bit far out, is going to be, quantum computing. And I think that's going to really help the healthcare industry. But I think that one's probably several years out from when we really see anything material.
Yeah, good. Thank you for that. We got I think just one more question here. Thoughts if the Supreme Court says Trump can't do tariffs and the U.S. has to issue refunds? That's a good one. That's a good one. Good question. Uh, Hard to know exactly, but what I'd say is the stock market likes bad news better than it likes uncertainty. So if that were to happen, I think you would see a plunge of sorts until things kind of get figured out. But I think over time things would rebound. There'd be some industries, obviously, that would be relieved if that were to happen. Some countries like Brazil. I mean, you have all this CARES negotiation. If that were to end, I think that would cause some relief in some areas, but cause just uncertainty around that pinpoint moment. And I think we'd see a lot of volatility on that. But I do think it'd be shorter term. It would correct itself with time.
I think it'd be one of those short-term blips that we talk about. I mean, but I can't see that ever really getting in the way of this kind of technological revolution we're seeing. We pointed out it's not going to stop people from buying an iPhone, obviously,
Yeah.
with how many have been bought with the new iPhone launch. So
Yeah, no, I agree with that. And again, people put a lot of emphasis on who's in the White House and the economy. And like what you said, yeah, whoever's in the White House doesn't cause Apple to sell more iPhones or more baskets to leave Costco. Earnings of U.S. companies, whether it be industrials, whether it be in finance or tech or whatever, as they innovate, as they be good stewards of the capital that they are and for their employees, that's really is what going to drive earnings, and earnings are what's going to drive the stock market. So I would agree with you on that. I think that's it. So, all right. Thank you everyone for attending. Thanks for your time today. We went a little over. This will be recorded, so we'll be sending out a replay email if you know of anyone that hasn't seen or would like to see it. We'll get that sent out. But again, thank you for your trust in our firm. We get up every day energized. We love what we do, and we get that privilege because of your trust in us as a firm. So thank you very much, and enjoy the rest of your week.
thanks.